The power of chart patterns. Alright, listen up traders. You, staring at those charts wondering which way the market's gonna swing. What if I told you that hidden in plain sight are signals? Signals so powerful they could revolutionize your trading game forever. This is about making your money work harder for you. This is about turning confusion into confidence. Ever feel like you're just gambling, tossing a coin on whether a share price will go up or down? It's frustrating, I know, I've been there. But what if you could spot the turning points before they happen? What if you had a map, a guide, to navigate these choppy market waters? Well, guess what? Such a map exists, and it's all about understanding chart patterns. Today, we're diving deep into two of the most reliable, most powerful patterns out there, the double top and the double bottom. Master these, and you're not just trading, you're strategizing. You're making informed decisions. This isn't just theory, this is practical knowledge that can lead to better entries, smarter exits, and potentially much healthier profits. Get ready to learn, because knowledge is money. These patterns can be sneaky. Stick with me and I'll show you how to spot them, how to understand them, and most importantly, how to trade them. Are you ready to get that edge? I thought so. First up, let's talk about the double top. This is one of the most recognizable patterns in technical analysis. Picture this. A share price climbs high, hits a ceiling, then pulls back. It's like a roller coaster reaching its peak and then descending. Buyers try again, pushing it back up to that same ceiling. They're hoping to break through and reach new heights. But bam! It hits that resistance level and can't break through. The market just doesn't have the strength. It's like a boxer hitting a wall twice. That second failure to push higher is your big clue. It's a sign of weakness. It often signals that the buyers are exhausted and the sellers are about to take control. The momentum shifts. This pattern looks like the letter M. It's a visual cue that's easy to spot. Remember M for mountain, or M for maybe going down? It's a handy mnemonic. So, what's the science here? That first peak? That's where early buyers are taking profits, and sellers start to test the waters. It's a tug of war. The pullback shows some profit taking. It's a natural part of the market cycle. Then, renewed optimism pushes the price back up. Buyers are hopeful for a breakout, but if it fails at that same level, it tells you the big money isn't convinced. The resistance is too strong. There isn't enough buying power to break new highs. The market sentiment is shifting. This resistance level becomes a critical line in the sand. It's a psychological barrier. A break below the trough between the two peaks is your confirmation. It's the final nail in the coffin for the bulls. Now let's flip it for the double bottom. This one's your friend in a downtrend. It's the mirror image of the double top. Imagine a share price falling, finding a floor, and bouncing. It's like hitting a trampoline. It tries to fall again, hits that same floor, and bounces back up, stronger this time. The support holds firm. It's like a trampoline giving it a double boost. The energy is palpable. This pattern looks like the letter W. It's a clear sign of potential reversal. Think W for win, or W for wow, it might go up. It's a bullish signal. This pattern signals that sellers are losing steam and buyers are stepping in with conviction. The tide is turning. A break above the peak between the two bottoms, the neckline, confirms the reversal. It's the green light for a potential uptrend. Let's get real with some examples. Think about a popular tech share, Innovate Corp. Back in early 2024, it rallied to £150. Big news, everyone excited. Then it pulled back to £135. A few weeks later, another surge of buying pushed it right back to £150. But it stalled. No new highs. Volume on that second peak was lower. Alarm bells. When it broke below £135, that neckline, it was a classic double top. The share then corrected down to £110 over the next couple of months. Textbook. Those who saw it coming saved themselves some pain or even made money shorting. Now for a double bottom. Consider Solid Foundations PLC, a construction company. After a tough year, its shares slid to £5. It bounced to £6, then fear gripped the market again and it retested £5. But it held. Buyers stepped in with force. Volume picked up on that second bounce. When it decisively broke above £6, that was your signal. Solid Foundations then rallied to £8.50. That's a W for wonderful. These patterns play out all the time on all sorts of assets. You just need to train your eyes to see them. So what's going on in traders' heads during these patterns? It's all about market psychology, folks. Greed and fear, hope and despair. Understanding this emotional roller coaster is key to understanding why these patterns work. Section 4. Danger, danger. Avoid these trading pitfalls. Now let's talk mistakes. Because believe me, traders make them. And these mistakes can be costly. The biggest one with double tops and bottoms, jumping the gun. This happens more often than you think. Seeing two peaks that look roughly the same height and screaming double top before it's confirmed. It's a rookie mistake. Or seeing a price bounce twice from a low and yelling double bottom. Too early. Premature decisions can lead to significant losses. Patience, people. You must wait for the neckline break. That's your confirmation. Without it, you're just guessing. Without it, it's just a potential pattern, not a trading signal. And trading on potential rather than confirmation is risky. Acting too soon is like swinging at a bad pitch. You'll strike out. Timing is everything in trading. Another classic blunder, ignoring volume. Volume is crucial in validating patterns. Volume is your truth serum in the market. It tells you the real story behind price movements. For a double top, you ideally want to see lower volume on the second peak compared to the first. This indicates weakening buying pressure. This suggests less conviction from the buyers, a crucial sign that the trend might reverse. Then, you want to see volume pick up when the neckline breaks, confirming the sellers are in control. This is your green light. For a double bottom, look for higher volume on the breakout above the neckline. This shows strong buying interest and potential for a trend reversal. This shows strong buying interest. It's a positive sign that the market is ready to move up. Ignoring volume is like driving at night with no headlights. You're navigating blind. Misjudging the distance between the peaks or troughs is another one. Proper spacing is key to identifying valid patterns. If the two tops or two bottoms are too close together in time, it might just be noise, not a true reversal pattern. Noise can mislead you. You need some breathing room between them. This helps in distinguishing real patterns from market noise. Also, the depth of the trough for a double top or the height of the peak for a double bottom matters. Context is everything, folks. Always consider the bigger picture, and don't forget the overall trend. Patterns don't exist in isolation. These patterns are typically reversal patterns. They signal a change in the market direction. Always zoom out. Look at the bigger picture before you zoom in on the pattern. This will give you a better perspective and improve your trading decisions. Section 5. Your secret weapon: nailing these patterns like a pro. So, how do you become a double top and double bottom detective? First, train your eyes. Look at hundreds of charts. Seriously. Go back in time on your favorite shares or indices. Spot these patterns after they formed. See how they played out. This isn't about predicting the past, it's about pattern recognition. The more you see, the faster you'll spot them in real time. It's like learning a new language. Practice makes perfect. Or in this case, practice makes profit. Quick tip number 1. The neckline is king or queen. I can't say this enough, the pattern is not complete and you should not be trading it until the price breaks through that neckline. For a double top, that's a break below the low point between the two peaks. For a double bottom, it's a break above the high point between the two troughs. This breakout should ideally occur with increased volume. Quick tip number 2. Measure for your target. Once the neckline is broken, these patterns often give you a potential price target. For a double top, measure the distance from the highest peak to the neckline. Then subtract that distance from the neckline breakout point. For a double bottom, measure the distance from the lowest trough to the neckline. Add that distance to the neckline breakout point for your upside target. Quick tip number 3. Use stop losses. Trading is about managing risk always. Protect your capital. That's rule number 1, 2, and 3 in this game. Section 6. The final trade recap, rally, and riches. Alright, let's bring it home. We've covered some serious ground today, and it's time to wrap it all up. We talked about how understanding chart patterns, specifically double tops and double bottoms, can stop you from guessing and start you on the path to winning. These patterns are crucial for any serious trader. These aren't just squiggly lines, they are messages from the market, telling you about potential reversals. They are like a secret language that, once understood, can give you a significant edge. They are your early warning system and your opportunity bell, all rolled into one. Recognizing these signals can be the difference between a profitable trade and a missed opportunity. We define the double top, that M shape, signaling a potential move down, and the double bottom, the W shape, hinting at a rally. These shapes are not just theoretical, they appear frequently in real trading scenarios. We saw how real-world examples play out and delved into the market psychology, the fear and greed that drive these formations. Understanding the emotions behind these patterns can help you anticipate market moves. We also shone a bright light on those common, costly mistakes: jumping the gun, ignoring volume, and misjudging the pattern's context. Avoiding these pitfalls is essential for long-term success. Knowing what to do is just as important as knowing what not to do. It's a balance of knowledge and discipline. Then we armed you with practical tips, the supreme importance of the neckline break, how to measure for potential price targets, and the absolute necessity of using stop losses to protect your precious capital. These tools are your safety net in the volatile world of trading. Remember, spotting the pattern is only half the battle. Acting on it correctly with discipline is where the real skill lies. Discipline separates the amateurs from the pros. So, what now? Go out there and start looking for these patterns. Study them, Practice makes perfect, and the more you familiarize yourself with these patterns, the better you'll become at spotting them. If this has helped you, if you're feeling fired up, then smash that like button. Your support means the world to us. Drop a comment. Let me know what other chart patterns you want me to break down. Your feedback helps us create better content. And subscribe for more hard-hitting trading wisdom. Stay tuned for more insights and strategies. Now go make some money. Booyah! Let's turn those patterns into profits.